Hello everyone. In this video we will be starting the exam kit, the Kaplan exam kit of F3 financial accounting. So I think I'll be making about 6 to 7 videos wherein we'll be solving the entire Kaplan exam kit, or even it might take a bit more videos as well. So before watching this, make sure that you watch the chapter explanation videos. If you haven't, I have linked it in the description box below. And now let us start with solving the questions. Make sure that you are solving the questions along with me so you can check your answers with me. You can pause the video, solve it, and check it with me. Otherwise, if you haven't studied this chapter and if you're only watching the exam kit solutions, then it might not be beneficial. Okay, so let's quickly start with the first chapter, which is the context and purpose of financial reporting. So, the first question: which of the following statements is true? The directors of a company are liable for any losses of the company. Are the directors responsible? No. A sole trader business is owned by shareholders and operated by the proprietor. No. You know that in the sole trader business, the owner is only one person, the sole trader. So that's not true. Partners are liable for losses in a partnership in proportion to their profit share. See, partners are jointly liable, but it might vary. A company is run by directors on behalf of its members. That's true. So you know that a company is always operating activities are run by the directors. Which of the following statements best defines a statement of financial position? So what is a statement of financial position? That is a balance sheet. It is a summary of income and expenditure. It is a summary of cash receipts and payments. It is a summary of asset, liability, and equity. Got the answer? Which of the following statements best defines statement of profit and loss? This is the P&L account. It is a summary of assets and expenses, income and expenditure. So what is the answer? The answer is obviously D. Which of the following user groups is likely to require the most detailed financial information? So who would require the most detailed financial information? So always the management will only require the financial information. Why? Because management will require the detailed information because management is always responsible to make the informed decisions regarding the operative activities. See, the investors, potential investors, government employees, even they require the financial information. They require, but who requires the most detailed? It is the management. Which of the following statements are true? Accounting can be described as the recording and summarizing of transactions. Financial accounting describes the production of a statement of financial position and a statement of P&L for internal use. So, this is not true. The second one is not true. Why is it not true? Financial accounting describes the production of financial statements. That is correct. But for what? For internal use? That's not true. They are always given for external use. Financial statements, we know that financial accounting is for external use and management accounting is for internal use. So only one is correct. First one is correct. Why? Because accounting can be described as recording and summarizing of transactions. What is the main purpose of financial accounting? To record all transactions in the books of accounts. To provide management with detailed analysis of costs. That's not true. Why? Because that is management accounting. To enable preparation of financial statement that provides information about an entity's financial performance. That is correct. See, these are all half information. The complete information of financial accounting is given in the C option. Which of the following statements does not explain the distinction between financial statements and management account? So which is not a difference? Financial statements are primarily for external users and management accounts are internal users. That is correct. Financial statements are normally produced annually and management accounts are done monthly. Financial statements are more accurate than management accounts. Financial statements are audited by an external auditor, and management accounts do not normally have an external audit. So the C is answer. Why is C answer? Because financial accounting, management accounting, both will be accurate. Right, both of them are equally accurate. So this is not a distinction. Okay. Which of the following items is the IFRS Advisory Council responsible for? So, the IFRS Advisory Council, what is it responsible for? To give advice to the ISB, to give advice to the ISB on agenda decisions. Which is the answer? The answer is A. Why? Because ISB, we are talking about IFRS Advisory Council. So the duty of Advisory Council is both of them to give advice. Which of the following statements best defines a liability? So we are talking about the definition of a liability. A liability is an obligation arising from a past transaction or an event. A liability is a legally binding amount owed to a third party. A liability is a present obligation of the entity to transfer an economic resource. A liability is anything which results in an outflow of economic benefits. So the answer is obviously C. Why? Because this is the definition of liability. Okay, I'm giving you a minute to do the 10th question, then I will discuss. Are the following statements true or false? International accounting standards are effective only if adopted by national regulatory bodies. Yeah, if the accounting standards are not regulated by the every country's national bodies, then there's no use, right? Accounting standards provide guidance on accounting for all types of transactions. For all types of transaction, that is not true, because sometimes there might be transactions which do not involve accounts, right? Which of the following statements best defines an expense? Okay, which one is the definition of expense? Read it and tell me. D is the answer. Simple. No need to discuss this. Which of the following statements is true in relation to a partnership? A partnership is a separate legal entity. A partnership is jointly owned and managed by the partners. Partnership can raise capital by issuing shares to the public. A partnership is able to own property and other names on its own name. So the answer is obviously B. That's the definition of partnership, that two or more people are maintaining it. And this is not true, because we know that in sole trader and partnership, there is no separate legal entity. Okay, the 13th question. Which of the following statements is true in relation to a sole trader? A sole trader cannot have any employees. A sole trader is able to introduce or withdraw capital anytime. A sole trader has limited liability. A sole trader can operate a business from only one location. So, what is the answer? The answer is obviously B, right? That a sole trader, he can do drawings and he can withdraw or add capital anytime he wants to, because he is the one and only owner of the company. Which of the following statements is true in relation to a limited liability company? A limited liability company can incur liabilities in its own name. A limited liability company cannot acquire assets in its own name, cannot incur liabilities in its own name. A limited liability company can be formed on an informal basis by an agreement. So the answer is A. So we know that a limited liability company and the owner have two separate legal identities. We know that, we've studied that. So obviously we can incur liabilities on my business's name. Which of the following items could be used to encourage executive directors to operate in the best interests of the company? They could be awarded a high salary, they could receive bonuses, they could be entitled to a large payment, they could be asked to attend the annual general meetings. So the answer is bonus. So they can be given bonus, right? We can keep some bonus items, and bonuses are completely legal in the UK. Which of the following statements relating to a partnership of 20 persons and a limited liability company with 20 shareholders, each with 5% shareholders, is true? So which one is true? Both partnership and limited liability companies are able to own assets in their own name. Is that true? That is not true. Why? Because we know that partnership and the owner do not have a separate legal entity, they have the same legal entity, so that is not true. The members of a limited liability company have the right to participate in the management of that company, whereas partners do not have the right to participate. That's not true. Even partners have a right to participate, right? So even this is not true. The partners have the right to participate in the management of the partnership, whereas members do not have the right to participate in the management. That is true. So just because someone is a member of a company doesn't mean that they have the right to participate in making the decisions, right? Until and unless you are the owner in a company, until and unless you are the owner in a limited liability company, you will not be allowed to make decisions, right? So partners are the owners, so they are allowed to make decisions. So the answer is C. Let's still see what the D is. Partnerships are subject to the same regulations regarding as a limited liability company. That's not true. The way partnerships and sole traders operate versus the way limited liability companies operate are very different. Which of the following is the most obvious means of achieving public oversight of corporate governance? Okay. How do you, which is the most obvious way using which you can achieve public oversight of corporate governance? So, the company is establishing a comprehensive website, publication of the annual report and accounts. So, do you know that public oversight? If you can recall from the video, if you haven't watched it again, please go and watch it. I will link everything in the description box below. So, you remember what public oversight is? Public oversight means you are publishing your financial statements, your annual reports and accounts to the public. So B is straight, the definition of the public oversight is B. So B is the answer. Which of the following items would not be included in a sole trader's capital? Equity share capital, revaluation surplus, personal drawings and capital account. Equity share capital. Okay, why would equity share capital not be included? Because equity share capital is only there in limited liability companies. See, you know that a sole trader will not raise money using shares, right? We know that in a sole trader's capital, why will equity be there? Equity share capital is always there in a limited liability partnership or limited liability company. Which of the following pairs of items would you expect to see in the financial systems statements of a partnership? Dividends paid and share premium account. Would you expect to see share premium account? Okay. Capital accounts. Give me a second. My pen is not working. Yeah. Capital accounts and profit appropriation account. Share premium account and capital account. Okay, again, same thing. Share premium account will always be in your limited liability companies, not in partnerships. So, what will be there in the partnership if you discuss that? Even dividends also will be there only in limited liability companies. So, the answer is B, because partnerships have capital account and profit appropriation account. So, profit appropriation is always done between partners. But when you talk about dividends are given on shares, right? And shares can be raised only by companies, not by the partners or the sole traders. 20. Which body is responsible for the issue of international financial reporting standards? Okay, which body is responsible to issue it? If you can recall it, the IASB is always responsible for issue of the financial reporting standards. So it is IASB. Are the following statements relating to the IASB's conceptual framework for financial reporting true or false? So, is it true or false regarding IASB's conceptual framework? It is a financial reporting standard. No. When was it ever mentioned that it is a financial reporting standard? It assists in developing IFRS based on consistent concept. That is true. It assists preparers in development. Okay, that is also true. Assists all parties in understanding and interpretation. That's also true. Which of the following statements best defines an asset? What is the definition of an asset? If you can recall it. Result of past. So D is the straightforward definition of an asset. No doubt in that. Which of the following statements best defines the equity or capital of a business? Okay. Equity or capital of a business is represented by the net values. Equity or capital is equivalent to the value of the business. Equity or capital is equivalent to the value of the business assets. Equity is represented by the total assets of the business. Okay, so what is the answer? Equity or capital of a business is represented by the net assets of the business. So whatever net assets are there in the business, using that we will be always representing the equity. You remember what equity is? Equity is nothing but capital. You remember the formula, and whatever the net asset is, that would be represented by the equity, right? Because that would be the valuation in a business. The net assets would be the valuation in the business. Okay, the qualitative characteristics of financial information. So we need to identify whether each of the following characteristics is a fundamental qualitative or enhancing qualitative, if you can recall the topic. So let's start. It is a financial reporting standard. Oh, sorry. Yeah. So let us start with it. Comparability. What was comparability? Was it fundamental or enhancing? If you can recall, comparability was enhancing. Timeliness was also enhancing. Faithful representation was fundamental. Understandability was also enhancing. So comparability, timeliness, and understandability were enhancing factors, and faithful representation was our fundamental. Which of the following statements is correct? So which one is correct? The going concern concept guarantees that a business will continue in operational existence for at least 12 months. No one ever talked about 12 months. The going concern concept guarantees that the business will go on for a foreseeable time period. And last 12 months, this term has never been mentioned in the definition, so this is not correct. To comply with the law, the legal form of a transaction must always be reflected in the financial statement. That is also not true. Why? Because legal things have not to be mentioned in the financial statement. This has not been mentioned anywhere. If a non-current asset initially recognized at cost is revalued, the surplus must be credited in the statement of cash flows. That is also not true. Why? Because it is not realized. Just because something has appreciated in the value doesn't mean that it is a realized gain or a realized profit. Because let's say, for example, I have a machinery of 10,000. After 4 years, machinery has a market value of 12,000, which means I have a 2,000 appreciation value, but I'm still using the machinery. I have not sold it. So if I have not sold it, then I won't be able to use the 2000 profit, right? So that means cash flow hasn't happened in the business. Cash inflow hasn't happened. So that is not true. In times of rising prices, the use of historical cost accounting tends to understate assets and overstate the profit. That is also true. Why? Because, see, when the prices are rising, what happens is that we use the historical concept. And if you can recall about the historical concept always understates the asset, because historically the value of the asset must have been less, right? Which means that the profits might also be overstated. Okay, let's see how many questions are left in this chapter. So we're almost done, and we'll stop this video with this chapter because we've done 3 chapters. According to the IASB's conceptual framework for financial reporting, are the following characteristics that enhance the usefulness of information or not? Relevance. So, okay, we are talking about according to IASB's conceptual framework. So comparability required? Yes. Is relevance required? No. Faithful representation? No, because these are not used in enhancing. Relevance and faithful representation are not enhancing, if you can recall, right? Comparability is enhancing and verifiability is also enhancing. Which of the following statements best explains the principle of faithful representation in relation to the preparation of the financial statement? The answer is D. This is very straightforward. Hope you can do it by yourself. Which accounting concepts requires non-current assets to be valued at cost less accumulated depreciation rather than enforced saleable value? So which concept says this? Going concern, right? If you think that the business we think that the business will go on forever, which means that we will never sell. So if we'll never sell, we will always we will not consider the saleable value. So the answer is D. Which of the following pairs of items are the 2 fundamental qualitative characteristics? Okay, we are talking about qualitative characteristics, fundamental ones, not enhancing. We're talking about fundamental. So this would be relevance and faithful representation. So relevance and faithful representation are fundamental. We know that. And prudence, materiality, comparability, all of them are enhancing. So what are fundamental? Relevance and faithful representation. Which of the following statements concerning the exercise of prudence is correct? So what is the answer? So under the conditions of uncertainty, we need to be cautious while making judgments. This is what is said by prudence, right? So that's it. We are done with the Kaplan exam kit of the first 3 chapters, or 4. I might be a bit wrong. 1, 2, 3. Yeah, I think it's. Let's just quickly go to the index and check how much we have done. Okay. So we have done the context and purpose, we have done the qualitative framework. So we have done these 2. In our books, these are 3 chapters, I think, or 2. So in the next video, we will be doing the double entry and recording the transactions. We'll be doing this in the next video. So I hope you understood the exam kit. If you haven't, make sure that you watch the chapter explanation videos, which will be linked in the description box below. Thank you.